Welcome back for another deep dive, this time tailored specifically for you. We're tackling a subject that's both fascinating and really fundamental to modern finance, finding alphas.
Right.
You've provided us with a really interesting stack of material, all pointing toward these predictive signals that quantitative traders seek out to try and gain an edge in the markets.
That's right. At its heart, an alpha is a model. You can think of it as a set of rules or an algorithm designed to forecast the future prices of financial instruments.
Okay.
It's essentially a mathematical way to express a hypothesis about which way a security's price might be heading.
And quantitative trading is basically taking these alphas and, well, trying to make money from them, right? Monetizing the predictions.
Precisely. The process of systematically trading based on these predictive alphas with the goal of generating profit is what we call quantitative trading.
Exactly. What's particularly compelling about the sources you've shared is the variety of viewpoints. We're getting insights from people really, on the front lines,
From those actively engaged in quantitative trading.
offering a blend of the why, like where do these potentially profitable ideas even come from, and the how, the very practical, technical steps involved in designing and, importantly, testing these alphas.
Rigorously testing them, yes.
So our goal today is to extract the most crucial insights, those key nuggets of information that will give you a strong grasp of this complex area without making you feel like you've just drowned in a sea of financial data. Okay, let's unpack this. So where did this all begin?
It's quite striking how the emergence of sophisticated alpha research and quant trading is so linked with technology.
The tech advancements, yeah.
The late 1980s and 1990s were a real turning point. That's when affordable and, well, powerful computing resources really became available for Wall Street trading.
Right, so computing power got cheaper, faster.
Exactly, the democratization of computing power, you could say. And this coincided with just an explosion of financial data being generated and collected in the late 20th century. It fundamentally shifted market analysis from human intuition more towards algorithmic prediction.
That makes complete sense. Suddenly, the capacity to process massive data sets and run complex calculations wasn't just for academics anymore.
Precisely. And with all this new information flooding in, there was a real need for advanced models to actually interpret it, to leverage it effectively.
Which explains the influx of PhDs.
That's a major reason, yes. We saw a significant influx of people with PhDs in quantitative fields. Math, physics, computer science moving into finance. They brought the essential skills to develop these innovative modeling techniques, these alphas.
So as these models started popping up, how do you even begin to categorize them? It feels like there could be just a huge number of ways to approach this.
Yeah, right. The landscape of alphas is remarkably diverse,
Yeah.
but we can broadly group them in a few key ways. One primary way is by the type of financial assets they trade. So things like individual stocks, ETFs,
Currencies, futures.
currencies, futures contracts, options, even bonds. And these alphas can be built to focus on just one type or operate across multiple asset classes.
And geographically, single country or global.
Both. Within a single country, across several, or even globally. That's one dimension.
Okay, so that's the what they trade. What about the when and the how?
Right. Another critical way to categorize is by the time frame. How far out are they predicting? And how often?
High frequency versus long-term trends.
Exactly. While the sources don't give super granular categories here, it's important to grasp that an alpha designed for, say, millisecond predictions is fundamentally different from one looking at trends over weeks or months.
Makes sense. And the information they use.
Yes. The third way is the type of information they utilize. This generally falls into four main buckets.
Okay, what are they?
Technical data, just price and volume history.
Yeah.
Fundamental data, looking at the company's underlying business, its financials.
Like earnings, debt.
Exactly. Then you have macroeconomic data, GDP, employment rates, that sort of thing. And increasingly, text-based data.
Text data.
Like news articles, social media sentiment, even company regulatory filings. Analyzing the text itself.
Wow. Okay, that's a really clear overview. Now, drilling down a bit, fundamental analysis. That's a familiar term. How does that fit into generating alpha for quant trading? It feels more like long-term investing.
That's an excellent question. Traditional fundamental analysis tries to figure out the true underlying value of a security.
It's intrinsic value.
Right. By looking closely at the core factors affecting a company's business and its future potential. It's about the why behind performance.
As opposed to technical analysis, which is just the what of price moves.
Precisely. Now, in alpha design, we're mainly interested in the quantifiable fundamental factors, things we can measure, put numbers on.
So less reading qualitative reports, more crunching numbers from financial statements?
Exactly. The balance sheet, income statement, cash flow statement, these are essential data sources. Researchers extract quantitative info from these to design alpha signals.
Like what, specifically?
Things like revenue growth rates,
Mm-hmm.
debt solvency, can the company manage its debt, profitability levels, the amount of liquid assets it holds. These are all quantifiable metrics for predictive models.
And it's not just the big headline numbers, is it? I remember reading the footnotes matter too.
You're absolutely right. The footnotes accompanying financial statements can hold a surprising amount of crucial information. They give a deeper look.
Like what kind of details?
Changes in accounting methods, long-term supply deals, ongoing lawsuits, details on executive stock options, stuff like that. It's about reading between the lines.
Because companies aren't likely to shout about potential problems?
Generally, no. They're less likely to highlight them in the main reports. And interestingly, a noticeable increase in the number of footnotes can sometimes be a red flag itself.
Suggesting they might be trying to bury something?
It could suggest that, yes, requires investigation.
Like a financial detective looking for clues. So how does this fundamental data then lead to trading strategies?
Well, it can be key in creating stock classifications. A classic one is distinguishing value versus growth stocks using financial ratios.
Okay, value stocks being cheap relative to earnings or book value?
Typically, yes.
Yeah.
Trading at low prices compared to earnings, book value, sales, often high dividend yields too.
And growth stocks are the opposite.
Generally, yes.
Hmm.
By identifying these fundamental categories, researchers can then see how these groups tend to behave in the market and build alphas to capitalize on those patterns.
Okay, that gives us a good sense of where alpha ideas can come from. But how do you actually take an idea and turn it into something a computer can trade? Can you walk us through a simplified example?
Certainly, let's imagine we're focusing on two big tech companies, say Google and Apple.
Okay.
Step one, collect information. Let's say we have their daily closing prices for the past week. We also know about an upcoming industry event. It'll affect tech, but we're not sure if it's positive or negative, a non-directional event.
Okay, data acquired. What's next?
Step two is to formulate an idea. We look at the price data, maybe notice both stocks trended up last week.
Right.
A plausible idea could be, after these gains, maybe some investors will take profits. That means downward pressure.
Or if prices dip, maybe others see a buying opportunity, pushing them back up.
Exactly. It's a bit of a contrarian idea, maybe assuming mean reversion in the short term.
So the idea is these trends might reverse quickly.
Potentially, yes.
Yeah.
Now, step three is translating this into a mathematical expression. A simple one might be alpha in max 1 week returns.
Okay, explain the negative sign.
The negative sign is key. If the past week's trend was up, positive return, the alpha is negative. That suggests a short position betting the price goes down.
And if the trend was down, negative return.
Then the alpha is positive, suggesting a long position betting the price goes up. And the magnitude of the alpha value could determine the size of our trade in each stock.
So a really strong upward trend means a bigger short position.
Precisely. Finally, step four is refining this. Make it more robust. Remember that tech sector event?
Yeah, the uncertain one.
If our current alpha says go long on both Google and Apple, and the event hits the whole sector negatively, we could lose big on both.
Right, bad correlation there.
So to mitigate this sector risk, we could use what's called a sector neutral strategy.
How does that work in this simple case?
In our two-stock example, it might mean allocating roughly equal dollar amounts long on one and short on the other based on their individual alpha signals.
So you're betting on their relative performance within the sector, not the sector itself.
Exactly. It reduces the impact of a broad sector move on the overall portfolio.
That makes a lot of sense. Managing risk by not making directional bets on the whole group. Okay, so you have this math expression, this refined alpha. How do you know if it actually works? That's where backtesting comes in, right?
Yes, backtesting is absolutely vital. You take your alpha, apply it to historical market data, and see how it would have performed.
A historical simulation.
Right. It gives you an idea of potential profitability, risk, how it behaved in different past market conditions. And this is critical. Strong past performance is absolutely not a guarantee of future success.
The classic disclaimer. But what are the specific dangers of relying too much on backtests?
The biggest danger is overfitting. Huge problem.
Explain overfitting again.
It's when you find patterns in the historical data that are just random noise,
Yeah.
statistical flukes. They look good in the past, but have no real predictive power going forward.
Like seeing shapes in clouds.
That's a good analogy.
Yeah.
If you tweak your alpha enough times, try enough variations on the same historical data, you can almost always make it look amazing for that specific period, even if the core idea is useless.
So how do you avoid fooling yourself? How do you separate real signal from that noise?
Several important techniques help mitigate overfitting risk. A key one is out-of-sample testing. You develop and optimize your alpha using one chunk of historical data, and then test it rigorously on a completely separate historical data set that it's never seen before.
Data it wasn't trained on.
Exactly. And a true out-of-sample test, ideally, means deploying it forward in time, live or simulated live, after all development and backtesting is done.
So just using older data isn't really enough? Or testing on only some stocks?
No, that doesn't truly qualify as robust out-of-sample testing. It's too easy to indirectly contaminate the test.
Okay. What else helps?
Other techniques include using more data, longer histories, wider universes of instruments, though there are practical limits, of course,
Right.
plus more advanced stats methods like cross-validation.
Splitting data multiple ways.
Yes, splitting into multiple training and validation sets. Also, regularization, adding constraints to the model to stop it fitting the noise so closely. And incorporating prior probabilities, your initial beliefs about what's likely.
It sounds like a constant battle to tell if you found a real edge or just a historical coincidence. Now, what about those well-known effects like momentum? Stocks doing well, keep doing well for a bit. Are those alphas?
That's a really important distinction. Many well-documented, widely studied effects like momentum or the small cap premium.
Smaller companies outperforming larger ones over time.
Right. Those are often categorized as risk factors, not pure alphas. The thinking is they offer higher average returns over long periods as compensation for bearing specific risks associated with them.
So if I create a new alpha, how do I know I haven't just accidentally stumbled onto one of these known risk factors? Like, my alpha is just momentum in disguise.
That's a critical question for any alpha researcher. A new alpha, even based on cool new data like news sentiment,
Yeah.
might inadvertently load onto existing risk factors like momentum. For instance, positive news often follows stocks that have already been going up.
Okay, so they can be related. Is relying on these common risk factors bad?
There can be significant downsides. The quant crisis in August 2007 is a stark reminder.
What happened then?
Many popular quantitative risk factors suddenly experienced huge simultaneous losses. It was linked to widespread deleveraging investors reducing borrowed money.
So everyone relying on similar factors got hit at once.
Exactly, which is why it's generally much better to find alphas with low correlation to these known risk factors and also low correlation to the other alphas you're already trading.
Better diversification, less chance of everything blowing up together.
Precisely. Reduces the risk of simultaneous losses.
That makes perfect sense. Let's shift to the building blocks, data. It feels like the quality, maybe the uniqueness of the data you use could be a massive advantage.
Absolutely. Finding and accessing new, unique data sources is a highly valued skill for alpha researchers.
Why unique?
Novel data can lead to both better alpha performance and lower correlation with existing signals. That's diversification gold.
Because if everyone's using the same public data,
The signals they find might end up being intrinsically correlated, even if their ideas were different. A truly novel dataset gives you a shot at finding genuinely new, uncorrelated alpha.
but it's not just about having more data, right? The quality must be crucial.
Indeed, rigorous data validation, really understanding its quality, is essential. You need to find and fix technical errors, glitches in feeds, and human errors too.
Like typos or format changes.
Unexpected format changes, incorrect entries, yeah. And another key thing with data, especially from vendors or when looking at Polish models, is survival bias.
Survival bias. What's that?
We usually only see the track records of the successful models or data sets. We don't see all the ones that failed and got thrown away.
So the picture looks rosier than reality.
It can create a misleadingly optimistic view of how easy it is to find good alphas or data.
That's a sobering thought. We're definitely in the big data era now. How has this flubbed information changed alpha research?
Well, the big data era, this massive growth in data variety, volume, velocity, has opened up incredible new paths for potential alpha discovery.
What kind of weird data are people looking at?
Researchers are exploring all sorts of unconventional sources. Academic studies looked at the SAD effect, seasonal affective disorder, correlating market returns with daylight hours.
Seriously, Daylight hours.
Yes. Or even if morning sunshine at the main stock exchange predicts returns that day.
Wow.
One really fascinating example, and the sources used Google Trend search data. They build trading strategies based on search query volumes that apparently significantly beat the market.
Google search is predicting stocks. That's wild. But hang on, with all this data, how do you tell if something like sunshine is really predictive or just a fluke correlation you found by looking at enough weird stuff?
That's the fundamental challenge, exactly. The risk of overfitting, finding these fake price-driving rules that look significant historically but mean nothing, that risk is much higher with big data.
Just because it worked in the past doesn't mean it's real.
Right. Just finding a statistically significant relationship doesn't automatically mean it reflects a genuine economic or behavioral driver that will last. The sources had a funny example.
Oh, yeah.
A 3964 formula that supposedly predicted World Cup winners based on adding up winning years. Worked for a while, then failed spectacularly.
Whoa.
Okay, the point is, while data mining might turn up impressive-looking flukes, building robust alphas needs a deep understanding of what actually drives prices and sound methods to capture that, not just pattern matching.
So with all this data and the need to find subtle signals, can you automate the search? Get computers to find alphas?
Yes, advancements in computing and stats have made automated alpha search a reality, using algorithms to systematically comb through huge datasets looking for potential signals.
Does it work?
When done thoughtfully, it can definitely boost discovery efficiency, generate lots of candidates quickly. But the trade-off is that many signals found this way are just noise, no real predictive power.
So garbage in, garbage out still applies.
Absolutely. Careful preparation of the input data, sophisticated search algorithms, and then rigorous testing of whatever the machine finds are all crucial.
What kind of data prep is needed? You can't just feed raw numbers in, right?
No. A critical step is making financial variables comparable across different companies. Like raw earnings for a small startup aren't comparable to IBM's.
So you turn them into ratios.
Right. Express earnings as a percentage of revenue, maybe. Create ratio-like variables. Or compare a company's current value for something to its own history. Look for big changes from its norm. That often holds predictive info.
This all sounds incredibly complex. Are there specific tools to help researchers? The outline mentioned WebSim. What's that?
WebSim is described as a web-based simulation platform. It's designed specifically to help researchers backtest their alpha ideas using various financial data sets.
Like fundamental data, price volume data.
Exactly, both are mentioned. Historically, building and testing alphas needed serious programming and stat skills. WebSim aims to lower that barrier with a more user-friendly interface.
So it's like a virtual lab for alpha experiments. What can you do with it?
It offers a command line interface where you can type in mathematical formulas for your alpha using lots of available data points.
But what if you want something more complex?
For more advanced users, it supports Python scripting, so you can code more intricate, custom alpha expressions.
And you can control the test, like which stocks, which time period.
Yes, you can set the universe of instruments, the backtesting time frame, and access various fundamental and price volume data fields.
Okay, how do you actually build the alpha inside WebSim?
You can draw on different alpha sources, ideas, from research papers, finance journals, standard technical indicators maybe.
Right.
And WebSim facilitates something called neutralization.
We talked about that, avoiding sector bet.
Exactly. It helps you group instruments, say by industry, and then normalize the alpha values within each group. This isolates your specific signal, avoids unintended bets on the whole group.
Comparing apples to apples within the sector first.
Right. Then the platform generates an alpha output vector. Basically, a weight for each stock in your universe tells you whether to go long or short based on the signal.
And how do you make the simulation realistic? You can't trade instantly in the real world.
Good point. WebSim lets you introduce a delay. So you might use yesterday's data to make today's decisions, which is more realistic.
Okay.
It also has a unit check feature. Helps catch if you've made a mathematical mistake, created a nonsensical formula, and you define the simulation duration easily.
What kind of math tools are built in?
A comprehensive set. Standard stuff like min, max, standard deviation, correlation sum, covariance, even functions to handle missing data points, count nans.
Okay, so you've designed your alpha, run the simulation. How do you understand the results WebSim gives you?
It presents a Sharpe ratio bracket. This compares your alpha's Sharpe ratio, the risk-adjusted return measure, against how other simulations on the platform have done, a benchmark.
Gives you context.
Exactly. Then you get detailed results, graphs showing cumulative profit over time, how the Sharpe ratio changed during the test.
And key numbers.
Key metrics like total return percentage, the overall Sharpe ratio, maximum drawdown, that's the biggest drop from peak to trough in your simulated portfolio value.
Ouch. Good to know that.
And it gives percentile ranks for these metrics, so you see how your alpha stacks up against others simulated on the platform.
What if you run loads of tests, tweak ideas? How do you manage all those simulations?
WebSim has a My Alphas page. You can manage all the expressions you've created and simulated there.
Like saving favorites?
Yeah, mark promising ones as favorites, delete the duds, filter your list by Sharpe, return, drawdown, even when you created it. You can rename them too, make them meaningful.
Sounds really useful for iterative development. Are there simple examples someone could try in WebSim and just to get started?
Yes, the platform offers some basic ones, like just use the inverse of the closing price as the weight, or the sine to square root of the close minus open price difference,
Simple ideas to test the system.
right? Or the log of the high-low ratio for the day. And for more complex stuff, there are Python tutorials right in WebSim showing how to code alphas and access market data within Python.
This has been a truly illuminating exploration
Wow.
into the whole intricate world of alpha discovery. It's clear it's this fascinating mix of theory, technical skill, and constantly dealing with uncertainty.
Absolutely. As we've seen from the sources, the hunt for alpha is continuous. It blends the art of generating ideas with the science of rigorously testing them with data.
And that constant battle against overfitting you mentioned.
That's ever present. Plus the critical importance of finding and really understanding your data. And increasingly using sophisticated tools like WebSim, they're all fundamental parts of this dynamic field.
It's remarkable how quickly it all keeps evolving, driven by tech and just this relentless competition for even a tiny edge in the markets. This deep dive, even though we covered a lot, really feels like just scratching the surface of this complex topic.
It's a deep field.
So if any of the concepts or examples we've talked about today really sparked your interest, we definitely encourage you delve deeper, look into those research papers, maybe even check out tools like WebSim yourself.
Absolutely. And on that note, thinking about how fast markets change, how adaptive they are, it raises a really interesting question for you, our listener. What novel approaches or maybe data sources do you think hold the most promise? What's the next frontier in this ongoing quest for alpha?